Hello and welcome to the lecture for part 2 of chapter 18. So this will be the last recorded lecture for our class, so the last time you have to stare at your computer and listen to my voice. I don't know if that's a good thing or a bad thing. So I want to start with just some examples of when we take a top-down approach, some of the significant deficiencies that we might find. So one might deal with management accountability. So that's where senior management takes a handoff approach, doesn't really provide much in the way of oversight to either with regard to internal controls or with regard to anti-fraud elements. Another would be an ineffective audit committee. Maybe they don't meet very frequently. Maybe they don't, as it indicates, they're actively engaged with the accounting staff in matters that pertain to internal controls and anti-fraud measures. So that would be an example of a significant deficiency. If they have an internal audit department, but maybe they're limited in terms of scope, maybe they're limited in terms of competence. It could be that the people aren't qualified to do their jobs, or one that isn't listed here that might also happen is an improper line of reporting. So I've indicated before we talked about internal audit that they should report directly to the audit committee. So if you have a situation where the internal audit staff reports to the controller, well, that would tend to inhibit their full exercise of their powers within a company. Again, in taking a top-down approach, looking at what the overall level of ethics and what the code of conduct is in the company. If it's something that's on a poster in the reception area, but nobody's ever heard of it or talks about it, that could be one indication that it's effectively non-existent. It could really be non-existent. They've never even had anything like that. And it could be ineffectively communicated, so that would be a problem. I'd look at whether or not the company has some form of whistleblower program. So is there a way that an employee could confidentially indicate that something is being done improperly without worry about retribution? What are their hiring and promotion procedures? So if they're not doing background checks, not calling on references, doing kind of a limited approach in terms of the people that are put in positions of trust, that would be a negative thing. And then what happens when problems do occur? So have people been fired for committing fraud, or do they get a slap on the wrist? Those kinds of things send a really significant signal to other employees in the company and would be an indication of a significant deficiency. We'll talk about what the auditors will do with a significant deficiency next. So the auditor is also going to want to look at significant accounts and disclosures. So that would be any account that would potentially create a material misstatement on the financial statements. We'll do that based on the size and composition of the account, the volume of activity that goes through that account, so the kind of the numbers of transactions, what the nature of the account is in terms of its sensitivity to readers' perceptions of the financial statements. Again, if there are related party transactions, that's automatically going to make it a significant account. And then if it's changed significantly from the prior period. Now, all of what I've just described is something that would sound familiar to you because it's something we would do in the normal course of the audit anyways. But in this respect, we'll just kind of have an internal control lens on the topic. Another bit of review that we've talked about before is these categories of transactions, where routine transactions like paying employees, billing clients, shipping product and sending out invoices, receiving payment on those invoices, paying vendors, all of those kinds of routine transactions are one category. A non-routine transaction would be something that happens fairly infrequently. Year-end inventory, prepaid expenses happen infrequently and then are spread over time. So things that are kind of unusual, maybe large purchases, things like that. And then the third category are accounting estimates. That's where management has had to make some judgments about collectability, about future warranties, I would actually put depreciation expense under accounting estimates versus non-routine transactions now that I see it on the slide there, because management's making estimates about useful life and about salvage value. So the focus should be on the non-routine and the accounting estimates, just because those are areas that are kind of more ripe for error or misstatement. A key thing about what we would do as an auditor is sit down with staff and do a walkthrough of a transaction cycle. So, okay, what happens when you receive an order? What's the first step that's done? What's the second step that's done? And make note of what all the steps are, what approvals need to be done, what kind of preventative controls exist in the system, all of that. So we're going to look at all of that to figure out if the controls are designed properly and if they're actually being operated. So, or if they've been implemented, if they're in operation. So some of the questions you might want to ask, say you're sitting down with a bookkeeper and going through their billing process, you might want to ask what kind of errors that they have found in the past. So what has happened that was an anomaly, and does that happen very often? You might want to ask, what do you do when you get an error, when something doesn't work properly? Who do you go to and how do they help you and what's done about that? And then another question, and this again, you're kind of playing detective a little bit in doing this, is you could ask them if they ever have to override the controls. So if they tell you, yeah, when the controller is on vacation, he gives me his password and I can go in and override the control if I need to, that would be a red flag for you as an auditor. So the book had this graphic in it, and I thought I would pull it in here. I always like when there are kind of hard numbers versus judgments. So the frequency of a particular transaction or a particular control, how often that control is used, would indicate how many times we might want to test to show that it is being used properly, it is operating properly. So obviously the more frequently the control is employed, the more items we want to check to make sure it's being employed correctly. So I mentioned this before. If you look at the two types of audits, a financial statement audit and an internal control audit, there's obviously a lot of overlap. So the test of controls that we do for a financial statement audit can also be used for an internal control audit. The evidence that we get through those processes can be applied to both too. The key thing that's different is the objectives are different. So the financial statement audit, I'm looking at internal control through from the aspect of how much can I rely on that in determining how many substantive tests I need to do. I have to do substantive tests, but whether I do a small number of them or whether I go and do a deep dive is going to depend on the extent to which I can rely on their internal control, if it's designed effectively and operated effectively. The objective for an internal control audit is to issue an opinion about management's report on their internal control. Do they assess it correctly? And that's as of the end of the year, not over the whole year, but just as of a moment in time. So when a separate report is issued versus an integrated report, we had an example of an integrated report in the last chapter. So I wanted to show you an example of a separate report. So in this case here, the auditors audited Carver Company, and they talk specifically about the internal control on financial reporting. So they give their opinion, what their basis for their opinion is, the limitations that they have found, and then they sign it, indicate where they are located, their main office, and the date. So some of the items that if we determine them, what that would result in the opinion. If we find a material weakness, then we would give an adverse opinion. We would indicate that that there was a problem, we'd specify that. If there was a material weakness that was during the year, but it was fixed as of the last date, the date that it's shown, then we would either treat that as an unqualified. If we've tested the new system and they've fixed it, then it would be a clean opinion. If we did not have sufficient time to test it, then we would have a scope restriction. So everything looked good except for this, which we weren't able to check. If the client does not allow us to do a proper investigation, then we would either withdraw from the engagement or issue a disclaimer. If management's report is incomplete or improperly presented, we would give an adverse opinion, and then other issues we might add explanatory paragraphs if we needed to. So our communication of what we found in the internal control audit, all control deficiencies, regardless of their level of severity, we would communicate them in writing to management. And I think that's important from a liability perspective, from the auditor's standpoint, that we want that to be in writing, so that it's not, so that it's clear that we did document what we found and communicated that properly, so that they could take the necessary steps. If it rises to the level of a material weakness or a significant deficiency, we're going to want to communicate that to the audit committee. And then if we find that the financial reporting and internal control, oversight of financial reporting and internal control is ineffective, we want to communicate that to the total board of directors. So that's the second part of Chapter 18. If you have any questions, please don't hesitate to either give me a call or shoot me an email. Thank you very much.